So this presentation looks at the ratio calculations relating purely to the profit and loss account, looking at how profitable and efficiently the business is. The ratios are fairly straightforward, but do bear in mind that they tend to crop up in the exam more frequently than any of the others. So it's important you get a really good understanding of what the figures mean, and that you're able to write sensible answers to those exam questions. The calculations that I'm including on this presentation are based on the second set of figures that I've previously issued to you. So nearly all of the calculations that you'll perform on the profit and loss account tend to express the figure as a percentage of revenue. So whether it's the gross profit or the net profit or admin expenses, the calculation will always be the same. It's that particular figure from the profit and loss account times 100 divided by the revenue figure. So revenue is the 100%, and we're showing how much of that income is used up for each item in the profit and loss account. We can show this as a pie chart. The pies representing the revenue received, and we're showing here where that money has gone. So 55% in this case of the money received from customers is used up buying or manufacturing the goods that are sold. 20% of it goes in distribution costs, 12% in admin, and so on. So all of the ratios that we're calculating will basically show what fraction of that pie chart of revenue is represented by that particular item. Bear in mind also that clearly those remaining items after cost of sales in total represent the gross profit that we'll be showing in the profit and loss account as well. So when we start looking at the profit and loss account, it's always worth spending some time looking at and commenting on any changes to the revenue figure from one year to the next. And here's the most important point for you to remember in this regard, and if you remember it, it will help you avoid lots of missed marks when it comes to commenting on the accounts. And that important point is this: the figure in the profit and loss account simply shows the amount of revenue generated from sales to customers. It doesn't tell you how many units have been sold. So just because the revenue figure has gone up from one period to another, it doesn't necessarily mean that you've actually sold more units. There could be many reasons for that increase. It could mean that you've put the price up. So you haven't sold any more goods than you did last year, but you've sold them at an increased price. It could mean that, yes, indeed, you have sold more goods at the same price as last year. It could mean that you've actually reduced the price, and as a result of that price reduction, the total number of units sold has increased substantially. And so revenue has gone up over and above what it was in the previous year. Another possibility is that you could be selling fewer goods than last year at an increased price. Similarly, if revenue has gone down from one year to another, that doesn't automatically mean that you've sold fewer units of product. It could in fact mean that. It could mean that you've sold fewer goods, but it might mean that you've sold as many goods as you did in the previous year, but at a reduced price. It could mean that you're selling fewer goods at an increased price, or that you're selling fewer goods at a reduced price. We really don't know from the information that's available which of those it is. We can get a clue. We can get a clue from the changes in the gross margin, the gross profit percentage. And what I'd like you to do now is to just pause these slides and scribble down on a scrap of paper what you think the effect on the gross profit will be in each of the cases shown on this slide. So if we look at increases in revenue, if we sell the same number of goods but charge more for them, will that increase or will it reduce the overall gross profit? So just have a think about those, work through those items, and then pause the slideshow before you go on to the next slide. So let's see how you got on with those changes. An increase in revenue could be the result of any of these. If we sell the same number of goods at an increased price, then percentage-wise the cost of sales is going to go down, and therefore the gross profit margin, the gross profit percentage, will increase. In that case, a greater proportion of sales revenue is available to cover overhead costs. If you sell more goods at the same price, then although the gross profit will increase, the percentage of the selling price that is left after deducting cost of sales will be the same. So the gross profit percentage won't change in that case. Selling more goods at a reduced price is going to reduce the gross profit percentage, and selling less goods at an increased price will actually increase the gross profit percentage, increase the gross margin. Even though the actual total gross profit might go down, the percentage of revenue that's left after deducting cost of sales will still increase. And then if we look at reductions in revenue, the revenue figure going down could mean selling few goods at the same price. In that case, the gross profit will remain the same, or rather the gross profit percentage. Selling the same number of goods at a reduced price is going to reduce the gross profit percentage, or the gross margin. I use both terms. Selling fewer goods at an increased price will actually increase your gross margin. And very often firms do make the mistake of undervaluing their products, and so often you'll find businesses are struggling to meet demand for their products, and in that situation it's sometimes better to actually put the selling price up, because if you do that, you're going to lose customers that you might have difficulty servicing anyway. You're going to have to work fewer hours, but you might end up generating a greater profit. So selling fewer goods at an increased price will increase your gross margin. Selling fewer goods at a reduced price will bring that gross profit percentage down, and selling more goods at a reduced price will still bring that gross margin down. The percentage of the selling price that's left after deducting cost of sales will in both cases go down. So the important thing to remember more than anything is that the figure in the profit and loss account is just sales revenue. We do not know what's happened to the volume of products sold, although as I've already indicated, if we look at what's happened to the gross profit percentage, that might give us a bit of a hint as to the reason why that revenue has changed. Now, although generally speaking, increases in revenue are a good thing, you need to be aware that it might actually conceal a long-term problem, because it may conceal the fact that we're losing our market share and we've had to put up our selling price to compensate for fewer units sold. And as I've said before, the profit and loss account doesn't tell us how many units we've sold. It just tells us the revenue generated from sales. So we might have to increase the selling price to compensate for a falling market share, and ultimately that could mean that we end up going out of business. And that's something that you can often see, particularly on the magazine stall, when something becomes particularly popular. A few years ago it was the internet. Currently it's photography. You'll start to see more and more magazines hit the shelves, and to begin with there are one or two long-standing magazines that are there to satisfy demand, but once publishers wake up to the fact that this is the thing that's popular at the moment, more magazines will come online, and that means that existing businesses immediately lose some of their market share. And if you take note of the cover prices of the magazines, you'll see that they do gradually creep up as more and more magazines come onto the market, until eventually some of those magazines go out of business altogether. So just be aware that whilst increases in revenue in the short term are a good thing, it may disguise the fact that we're losing out on our market share if we've had to put prices up to compensate. So remember, we expressed the change in revenue as a percentage of the first year's figure. That's the calculation there. So if we apply that to our example figures, year 1 475,000, year 2 540,000, so the increase there expressed as a percentage of year 1's figure is 13.68%. And do remember, most important thing, that's an increase in revenue, not necessarily an increase in the number of units sold, but we might get an indication of that from the gross profit percentage change, if there is any, during the period. We've now got to, in the exam, comment on this change, and here's a suggestion as to the type of written answer you might put together, commenting on that change in the revenue figure from year 1 to year 2. I always suggest when writing these comments that you assume that you're writing to someone that doesn't have the figures in front of them, so it's always worth restating what the figures are and what the change is. And in most exam questions you won't be given lots and lots of detail, so you can only suggest what might possibly be, what could be the reason for the change, not narrowing it down to one specific thing. So we're saying there that revenue's increased, and always show it as a percentage increase as well. Suggest reasons why that change has taken place. And you'd probably get a few more points if you do make it clear that the number of units sold isn't shown there. We don't know how many units have been sold. We only know the amount of revenue generated from sales to customers during the period. But as I've said in my suggested answer there, it could be hinted at from the change in the gross profit margin between the 2 years. So let's have a look at the first of these ratios, the gross profit ratio, sometimes referred to as the gross margin, and those terms are interchangeable, and I'll use both of them from time to time. And like all the other ratios relating to the profit and loss account, it shows what percentage of revenue is left after deducting the cost of buying or producing the goods sold. So there's the formula. It's simply the gross profit figure divided by the revenue turnover figure times 100. That will give you the percentage. So if we look at the example that I've given you, year 1, the gross profit is 185, revenue's 475. That gives us a gross profit percentage of 38.95%. Now it's worth remembering that after we've calculated that, we can very easily work out what percentage of revenue is used up either buying in or manufacturing the goods that are sold, and it will simply be the difference between 100% and the 38.95% gross margin. So in the case of year 1, we know now that cost of sales accounts for just over 61% of the money coming into the business. For year 2, the gross margin's gone up slightly to 40.74%, and that immediately tells us that cost of sales for that year accounts for 59.26% of revenue. As with all of the ratios, there are a number of limitations that you need to be aware of, not so much for the exam, but when you come to use these in the workplace, it's really important to understand what the limitations are. And there are 2 big ones as far as the gross profit ratio is concerned. Firstly, we're only working on an average gross margin. If the company sells more than one product and each of the products carries a different markup and generates a different profit, then the gross margin will only show the average margin achieved from sales during the year. If the mix of products sold changes from year to year, then in that situation inevitably the gross profit calculation will show a different figure. The other thing to bear in mind is that this calculation assumes that everything in cost of sales is a variable cost, and I'll come back to that on future slides. But remember that cost of sales does include some fixed costs, so factory rent, factory overheads, depreciation and so on, items that won't change with changes in the level of sales. They're included in cost of sales, but these calculations work on the basis that everything in cost of sales is variable, and the figures will change as the number of units sold changes. Now, when it comes to interpreting the gross profit ratio, there is one mistake that frequently costs students a lot of marks in the exam. I do not want you to make that mistake, and you need to remember this. Do not make the mistake of saying that if the gross margin has increased, it means that sales have increased. That will never generally be true. Whether you sell 5 units or 50 units or 1,000 units, then provided the selling price of each unit and the cost of each unit stay the same, then the gross profit percentage will be constant. It's only revenue that's gone up or gone down from one year to another. We really don't know just what's happened in terms of units sold. So don't make the mistake when you're commenting on the gross profit ratio, and it's probably the ratio that crops up more than any other. Don't make the mistake of saying that the gross profit's gone up, which means that sales have gone up. That's not true. If the gross profit's gone up, yes, sales revenue has gone up, but not units sold necessarily. The other thing you need to remember, as I said in the previous slide, is that we're working on the basis that all costs in cost of sales are variable costs. So just to emphasize, if the selling price per unit and the cost price per unit don't change, then the gross profit percentage will not change. It will remain the same. And there's an example of that. If I sell 1 unit or 50 units or 600 units, yes, revenue is going to go up, and yes, the actual gross profit will increase as well. But that gross profit as a percentage of revenue remains constant at 20%, whether it's 1 unit, 50 units or 600 units. Do not say that if gross profit's gone up, it means that sales have gone up. Not always true. So if the increase in units sold doesn't account for changes in the gross profit margin, what could cause that gross profit to change? Now, in practice, as the slide says, the answer to that could be complex if there are many units being sold of different products. The product mix could make a difference to that, and so on. But in the exam, we're looking for relatively straightforward answers. And the important thing, if we assume that the same products are being sold from one year to another, and if there's more than one product, that the product mix stays the same, then the gross profit percentage will only change if the selling price per unit, if the revenue per unit, or the cost price of each unit changes. So if you think about it as a formula, the selling price per unit minus the cost per unit will give us the gross profit per unit, and we can work out the gross profit percentage from that. Now, the only time that that percentage figure will change is if either in the first case the revenue figure changes or the cost figure changes. That will give rise to a change in the gross profit percentage. If the revenue and the cost per unit both go up because more units have been sold, then yes, the gross profit will change, but as I've said before, the gross profit percentage will not change just because we've sold more. The gross profit will only increase if either the selling price per unit goes up or the cost price per unit goes down. And in the case of a reducing gross profit, it will only go down if we reduce the selling price or the cost per unit increases. And as I've said, in practice, there are going to be more complex reasons for the change, but as far as the exam is concerned, those are the only things that you need to be aware of, either a change in the selling price or a change in the cost price per unit sold. Those are the only things that will give rise to a change in the gross margin. So just to emphasize that, here's an example. An increase in gross profit, remember, can arise if the selling price goes up or the cost price per unit goes down. So here's an example of that. We start off with a selling price of 20 and a cost price of 12. That gives us a gross profit margin of 40%. If the selling price goes up by £5 and the cost stays the same, then our gross profit will increase, and in that case it's 52%. If the selling price stays the same but costs go down by £5, then again that will give rise to an increase in gross margin, in this case 65%. So the things that will cause the gross profit percentage to go up are those two things, either an increase in the selling price per unit or a reduction in the cost per unit. Similarly, reductions in gross profit are the reverse. The reduction can be caused by a decrease in the selling price per unit or an increase in the cost per unit. And again, there's an example of that where the selling price goes down by £5, and in the second example the cost goes up by £5. In both cases the gross profit percentage goes down from 40% to 20% and 15%. That's the most important things to remember when you're writing about the ratios and commenting on the changes in the exam, particularly when it comes to the gross profit percentage. So increased selling price, reduced cost will cause the gross margin to go up. Reduced selling price or increased cost per unit will cause it to go down. So if we were writing about these ratios in the exam, what might we say about the example that we've just looked at? First of all, remember always to state what the changes are, and where relevant, the effect it's going to have on profitability. So here I'm saying that the gross profit margin's gone up from 38.95 to 40.74. Small improvement, which means that more of revenue from sales is available to cover overhead costs. So once you've stated what the changes are, and whether that's a good thing or a bad thing, you then need to suggest reasons for that change. You will never or rarely be given in the exam sufficient information for you to identify the actual reason. So you need to make sure that when you're talking about changes that you're only suggesting possible reasons. So as I'm saying here, the increase could be the result of an increase in the selling price per unit or a reduction in the cost per unit, or possibly a combination of the two. And it's worth just mentioning that there could be other complex reasons, but there's insufficient information given to work out what's actually given rise to that change. If you remember, sales revenue has increased. That in itself, remember, would not give rise to a change in the gross profit percentage. Sales going up, sales of units going down won't change the gross margin. But this time, because sales revenue has gone up and in connection with that the gross margin has also gone up, as I say there on the slide, that could be an indication that the selling price per unit has in fact increased. Now, as I've said, in the exam, when it comes to explaining reasons for changes in the gross profit percentage, you only need to concentrate on those two things. A reduction in gross profit could arise if the selling price per unit goes down or the cost price per unit goes up, and an increase in gross profit percentage could result from an increase in the selling price per unit or a reduction in the cost per unit with the selling price staying the same. However, in the real world, as I've said before, the reasons for the change could be far more complex than that, and you need to be aware of this if you're starting to look at ratio calculations in the workplace. Some possible other reasons for the change, as I've mentioned before, if you're selling more than one product and those products aren't equally profitable, then a change in the mix of those products from one year to another could give rise to a change in the overall gross profit percentage. If in year one you sell more apples than pears and in year two you sell more pears than apples, then it could be your gross margin will change. There might be new products included in the profit and loss account that weren't there before. If they're not generating the same gross profit percentage as the existing products, that's going to change the overall margin. Changes in the way that the products are manufactured could make a difference, and also if there's breakdowns in machinery, if there's labour problems, if stock is written off, obsolete stock is written off, that will affect the cost of sales figure in the profit and loss account, and that's going to have an impact on the gross margin as well. And here's just one thing to remember when it comes to real world analysis of the gross profit percentage. Remember that in actual fact some of the costs in the profit and loss account will be fixed costs. So as revenue increases, as you'll remember, most of those fixed costs will actually be step costs. There will be a point at which those fixed costs need to increase. When we reach maximum capacity in our factory, we're going to need to expand into larger premises, and at that point in time the fixed costs are going to increase. So all fixed costs at some point are actually step costs. That will give us an actual total cost figure for production shown in the graph there, and if you consider that, you'll see that at these 2 points the gross margin, the gross profit percentage, will be greatest when we're making full use of our manufacturing facilities, when we're working 7 days a week, 24 hours a day. Then those fixed costs spread over the units that we're selling will be a minimum, and so our gross profit margin will be greatest at that point in time. So in the real world, it's worth bearing that in mind. As production increases, then we would really expect the gross profit percentage, the gross margin, to increase until we reach that point of maximum production. If we then have to move into other premises, then the gross margin is going to drop initially until we reach maximum capacity again, when the gross margin will be a maximum. So that's just something to bear in mind when you're considering these ratios in a real world situation. But that's not necessarily something that you need to incorporate in your exam questions, although a mention of the fact that some of the costs in cost of sales are actually fixed costs, that might get you the odd extra mark or two. And then just before we leave the gross profit, it's worth just reminding you not to confuse the gross profit percentage with the markup percentage. In this example, we've got sales of 150, cost of sales of 100, and gross profit of 50. When we calculate the gross profit percentage or the gross margin, we're calculating that gross profit as a percentage of the sales figure, and in this case it's 33 1/3%. The markup percentage also works on the gross profit, but instead of calculating it as a percentage of the sales figure, it's calculated as a percentage of the cost figure, and it's the amount added onto cost to arrive at the selling price, and in this example it's 50%. So the gross profit is the markup added onto cost to arrive at the selling price of 150. Don't confuse those two. Markup will always be a larger percentage than the gross profit percentage, because the gross profit percentage is calculating the gross profit as a percentage of the selling price. The markup calculates the gross profit as a percentage of the cost price. So just make sure that you don't confuse those two. So the other main ratio that you'll be asked to calculate in connection with profit and loss is the operating profit as a percentage, again, of revenue. So there's the appropriate calculation. Sometimes in questions it will ask you to calculate the net brackets operating profit, but it's the same thing. So there are the figures from the example that you have, and so for year one it's the operating profit of 102 as a percentage of the turnover revenue figure of 475, which gives you an operating profit of 21.47, and for year two there's a lower operating profit of 18.52. So that's not a good thing that the operating profit has been reduced. But when we come to comment on the operating profit, we need to consider it in connection with other things. Now, although the operating profit has been reduced, we've seen before that the gross profit percentage has actually gone up from 38 to 40, and that can only mean one thing. It can only mean that the admin costs and the distribution costs have gone up as a percentage of revenue, and in total those costs will be the difference between the gross profit figure of 40% and the net profit figure of 18.52, and so we can break that down, and we can show for year one that the admin expenses 5.9% of turnover, distribution costs 11.58% of turnover, and if we add those three together, the 5.9, 11.5 and 21.4, we'll get back to the 38.95 gross profit. And for year two, the figures are those. So we can see that both admin expenses and distribution costs have increased quite a lot, and that's the reason why the operating profit is lower, even though the gross profit is higher than it was before. And so if we calculate the increases, we've already seen turnover's gone up by 13 and a bit percent. Admin expenses have gone up by 60%, and distribution costs have gone up by just over 36%. So that's quite a dramatic increase in admin expenses, and that's something that would need to be investigated when we come to comment on the change in the ratios. Distribution costs, because revenue's gone up, that may indicate, as we've seen, that more units have been sold, which could be why the gross profit's gone up as well. If that's the case, then clearly distribution costs would be expected to increase slightly as well, but not by as much as they have. So the operating profit percentage on its own doesn't mean too much. It's best to look at it in connection with the gross margin and see what impact the changes in admin expenses have had during the period. So if we want to write about that in the exam, what could we say? I would suggest something along the lines shown here. First of all, as always, I would recommend stating what the figures are and what the changes are. So I'm saying here that the operating profit's fallen from 21.4 to 18.5, even though gross margin has increased. And that tells me that overhead costs have risen at a greater rate than sales revenue. And as I say there, revenues increased by 13%, but distribution costs by 36% and admin costs by a large 60%. And then suggesting that perhaps there is some justification for the rise in distribution costs if indeed the increase in revenues as a result of increased units being sold. We would expect the distribution costs to go up a bit, but then finally we need to say that both of those increases should be investigated to see, particularly for budgeting purposes, whether those increases are likely to be permanent in the future, to find out exactly why they have changed as much as they have. So that's the operating profit percentage, sometimes referred to as the net profit percentage. The net profit isn't generally used when it comes to ratio calculations for one good reason. If we look at an example here, we've got two companies. The first company raises 100,000 from shareholders, issues £100,000 worth of shares, and those shareholders get a £20,000 dividend during the year. Company B also gets £100,000, but instead of getting it from shareholders, it borrows that money from the bank, and instead of paying dividends to shareholders, they pay interest to the bank, in this example the same amount of 20,000. So two companies with the same amount of capital but from different sources, one from shareholders, one from the bank. If we look at the profit and loss account, you'll see that the profit after tax figure is very different for company A and company B. If you look at the operating profit, you'll see that both companies have got exactly the same result. Revenue, cost of sales, overheads are all the same, and so the operating profit is absolutely identical. But that's where the similarity stops, because, as the slide says, bank interest paid, that's shown in the profit and loss account as a finance cost, and it's deducted in arriving at the final profit. Dividends paid, however, are not shown as a deduction. Dividends paid are like drawings of the owner of a sole trader business. They're actually a distribution of the profit, not a deduction from it. And so the £20,000 dividend payment isn't shown as a deduction at all, which is why the profit after tax is different. It also has an effect, as you can see, on the taxation as well. So if you're comparing one company to another company to assess how well they're performing, looking at the final profit figure isn't always a good indication of which company is performing better, simply because it will be distorted by the way in which that company has raised its finance. The operating profit is a much better indication of how the company is doing, and that's why it's used in most of the calculations that we'll be looking at. So that's a look at the profit and loss account, and just remember, most of the calculations are expressing each of those figures as a percentage of turnover. So we calculate the gross margin at 73%, we calculate the operating profit at 53%, profit before tax we can calculate 36%, and so on. Think of that pie chart. It's showing how much of the pie is used up in each part of the business. Remember also that when the calculations are carried out, we can make some deductions to work out easily some other percentages, in particular with the gross profit. If the gross profit accounts for 73% of turnover, then we know immediately that the rest of the 100%, 27% of turnover, immediately goes out of the business again to pay for those products that are being sold. And similarly, we can say in this example, 20% of revenue is used up paying for overheads. That's the difference between the gross profit and the operating profit percentage. Interest 6%, and so on. So that's a quick overview of the profit and loss account. The calculations are fairly straightforward. It's the commentary on those changes from one year to another or from one company to another that you need to be fairly competent at to get good marks in this part of the exam. So that's the profit and loss account. I'll next have a look at the investor ratios to see what kind of calculations investors are likely to carry out to assess how good their investment's doing.